Welcome back to the Deep Dive. Our mission, as always, is simple. You bring us the source material, and we dig in to find the most critical, actionable knowledge for you.
And today we are plunging right into a real contradiction.
We really are. We're looking at a comprehensive market analysis from Christmas Eve, December 2025. And what you sent us, it just perfectly captures what we're calling the Goldilocks Paradox.
Exactly. The market narrative is just fundamentally split, and our job is to synthesize these competing signals.
Right. And the first thing that just jumps right off the page is, it's pure, unadulterated enthusiasm.
Oh, absolutely.
The S&P 500 just celebrated its, a staggering 38th record high for the year.
38th. That number alone just screams momentum, a just right economy.
But then you look just beneath that headline, and the skepticism is sharp. It's immediate.
It is. We had Wall Street analysts downgrading major high flyers. Stocks like Tesla and Netflix.
The very stocks that are supposed to be driving this growth.
Precisely. And maybe even more critically, you have a prominent economist, David Rosenberg, openly challenging the official 4.3% GDP growth figure. He's suggesting the actual growth was closer to just 0.8%.
That is a massive discrepancy.
Okay.
It's the public story versus the fundamentals.
It is. And this whole situation is so high risk because it really encourages emotional trading. We talk a lot about System 1 and System 2 thinking.
The fast and the slow thinking.
Right. System 1 is that fast emotional reaction, the voice that says, buy, the S&P is at a new record. But System 2, that's the slow, disciplined, data-driven analysis. It's the voice that asks why a major stock just got downgraded in the middle of a so-called bull market.
So our big takeaway today is that you absolutely must adopt that disciplined System 2 approach right now. This deep dive is going to show you exactly where the data doesn't line up and why relying on emotion, even at an all-time high, is just, it's financially dangerous.
So let's start with the good news. Let's break down this Christmas rally.
What exactly was driving the momentum on December 24th, especially with that thin holiday trading volume?
It really boiled down to a belief in this macro narrative of a perfect balance.
Okay, so the NASDAQ composite, it finished up a respectable plus 0.22%. The tech rally continued, and the overall market sentiment was slightly bullish.
And that bullishness was anchored by two pieces of macro news that sort of reinforced each other. The first was that strong Q3 GDP growth. It easily surpassed what everyone was expecting.
Right, confirming economic strength. Our source material gives it a high positive sentiment score, I think, plus 0.43.
Yeah. But strong growth, that usually makes people worry about inflation and then the Fed tightening, right?
Exactly. So what was the critical balancing act that stopped that fear from spooking the market?
That was the second piece of news, inflation moderation. The CPI data actually came in below expectations.
So that generated a plus 0.35 positive score.
Correct. So when you combine strong growth with cooling inflation, the market reads that as a green light. It's a license for the Fed to potentially pause or, even signal some flexibility on rates down the road.
And that is the ideal Goldilocks environment that the market is so aggressively pricing in.
It is, and you can see that perfect balancing act play out almost in real time in the bond market.
So how did this manifest in the 10-year Treasury yield?
Yeah.
It's usually the first to react to these signals, isn't it?
What's so fascinating is the volatility. The 10-year yield, the TNX, it initially spiked. It shot up right after that strong GDP data hit.
That's the knee-jerk System 1 fear. Growth is too hot, rate hikes are coming.
Exactly. But then, almost immediately, the yield fell back down because of that inflation moderation news. The two just canceled each other out. The yield settled almost flat.
So the market, especially on a quiet holiday week, decided, okay, the perfect balance is still here.
That's the belief. The belief that strong growth and slowing inflation can coexist is why investors are comfortable pushing indices to new highs.
That is the consensus narrative.
Precisely. But, and here's the critical part of the analysis, that foundational belief is being actively challenged by some serious undercurrents in the data that you just cannot ignore.
Okay, so let's dig into that counter evidence. We mentioned the economist Rosenberg dissenting on that 4.3% GDP figure, saying the actual growth was closer to 0.8%.
Yeah, and that's not just a small rounding error. That's a fundamental disagreement.
That kind of skepticism, coming from a prominent economist, it forces you to question the rally's entire foundation. What was his reasoning for such a massive deviation?
Well, the skepticism detailed in your source material is, it's pretty technical, but it's really important to understand. He specifically pointed to statistical distortions, particularly around inventory buildup.
Ah, inventory.
Right. So if a major chunk of that 4.3% growth is just from companies making stuff that they haven't sold yet, goods just sitting in warehouses, that's going to artificially inflate the GDP figure. Production counts toward growth, so.
So inventory buildup looks like strength, but only for a moment. It could actually be a warning sign that production is getting way ahead of actual consumer demand.
Exactly. It suggests the underlying demand is actually weaker than the headline number wants you to believe. The analyst also cited some reliability concerns around, the inflation adjustment methods and other statistical issues.
If we connect that to the bigger picture, why does questioning that one number, that 4.3%, matter so much to the market?
Because the GDP figure isn't just a number, it's the foundational expectation for Federal Reserve policy.
Right.
If the economy is actually crawling along at 0.8% instead of sprinting at 4.3%, well then the market, trading at record highs, is fundamentally overvalued. It's unprepared for reality. Market uncertainty skyrockets, and the whole premise for the Goldilocks rally just vanishes.
And that really puts the market's focus on short-term euphoria into some stark relief. And adding to that structural uncertainty, we had the Federal Reserve itself flagging a serious risk.
A tariff warning.
The warning that tariffs could lead to higher unemployment.
Which raises a really important question for you as a diagnostician of your own portfolio. Why is the S&P 500 hitting its 38th record high while the central bank is flagging a significant structural risk, like a potential recession driven by tariffs?
It's almost a complete contradiction, isn't it? If the foundation is shaky and the Fed is ringing alarm bells, why hasn't the market priced this risk in? Is it just ignoring them?
I think it's a failure of System 2 thinking. It's a massive time horizon mismatch. The market is just focused on the next 3 months. It's assuming companies can easily absorb tariff costs or, pass them on to consumers without hurting demand.
And that is often a huge overestimation.
A huge one, especially when you see consumer balance sheets are already showing signs of strain.
And we could see the immediate evidence of this skepticism showing up in specific high-profile stocks, that valuation pressure on the high-flying growth names.
Right. The analyst downgrades for Tesla and for Netflix. That was high-impact negative news. Analysts are starting to realize that growth at any price isn't a winning strategy anymore. The bar for justifying those massive valuations has gotten much, much higher.
We even saw a really specific signal within the tech sector itself. Axcelis Technologies,
Right.
ACLS, its stock dropped despite the NASDAQ climbing.
And they cited explicit concerns in the semiconductor equipment sector. That is a classic warning flare. It's about future capital spending. It's about future tech demand. It shows that even within this tech rally, capital is becoming intensely selective.
Which leads us directly into the idea of sector rotation.
Exactly.
So the tech rally is selective, it's not universal. We're
Mhm.
still seeing investment in certain areas like Harbor Capital continuing to bag AMD-related funds. That signals long-term confidence in specific AI chip companies.
But the downgrades show that the days of just passively buying a tech index full of high PE stocks might be coming to an end.
The pressure is hitting what we call high-duration assets, right?
Right. Stocks whose valuations rely heavily on profits that are way out in the future. The ones with those high price-to-earnings ratios. When uncertainty rises, investors, they shift. They move toward quality assets that offer value now.
And the source material highlights a definite acceleration of that shift. The appeal of defensive value plays on the very same day.
That's the rotation happening in real time. I mean, look at the positive outliers. Merck, MRK, was specifically called an undervalued stock by analysts recommending a buy. It's a classic defensive value play.
And Novo Nordisk and VO, it just continued to outperform.
Driven by that structural, inelastic demand for its obesity treatments. That's a trend that doesn't care about a recession.
Even in financials, Morgan Stanley MS, it outperformed, which suggests investors are maybe betting on interest rates stabilizing, which would help their business.
The strong performance of these defensive sectors, healthcare, staples, select financials, alongside only selective growth stocks, it shows that capital is quietly shifting. It's hedging its bets against all this macro uncertainty.
And for you, the listener, this means a passive index approach is just significantly riskier today than a selective one.
So what does this all mean? How do we translate this conflicting data record highs on one side, fundamental overvaluation on the other, into an actual investment strategy?
This sounds like the moment for the System 2 imperative.
It is. Given the uncertainty, the high valuations, I mean, 38 record highs, and the structural risks like tariffs. Relying on your gut feeling is just dangerous. You need a disciplined, data-driven strategy.
So we need concrete numbers-based rules. What are the shoulds for portfolio health right now, according to the source material?
The sources give us 3 concrete, non-negotiable rules for immediate action. First, check your high PE limit. Stocks with a price-to-earnings ratio over 40. They should not exceed 20% of your total portfolio.
Okay, why 20% specifically?
That 20% limit comes from portfolio modeling. It's about figuring out the maximum concentration of high-risk assets you can hold while keeping your potential losses manageable during a correction. If those stocks fall 30%, you want to limit their overall damage. So if you're over 20%, it's time to trim.
Okay, Rule 2 gets at that rotation into stability.
Correct. You have to establish a defensive floor. Ensure a minimum of 25% of your portfolio is in defensive sectors: healthcare, consumer staples, utilities.
And again, that 25% isn't an arbitrary number.
Not at all. It's modeled as the minimum allocation you need to significantly soften the blow if the market has a 10–15% adjustment. It absorbs some of that shock.
And rule number 3 is about liquidity, especially important in these kinds of volatile, thin markets.
You have to ensure a significant cash buffer. Maintain a 10–15% cash position. This does 2 things. It mitigates risk, but crucially, it transforms market volatility from a threat into a strategic opportunity. That cash lets you execute your buy list when prices inevitably correct.
Beyond just asset allocation, tactical risk management is also key.
Absolutely. You have to strengthen your risk management. That means setting clear stop losses, say 15–20% below your purchase price on those high flyers, to protect your capital. And more importantly, you have to be prepared.
Use System 2 thinking now to create that buy list.
Exactly. Focus on quality companies that are trading at better valuations. Maybe look for firms with a PER under 20, but with a clear growth rate over 15%. This takes all the emotion out of it when panic eventually hits.
That disciplined approach is exactly what allows a long-term investor to profit, no matter which way the macro wind is blowing. So as we look ahead to Q1 2026, what are the big structural opportunities in the scenarios, the source material projects?
On the opportunity side, we see money flowing into 2 main areas. First, selective AI. Capital is moving away from the overheated hardware stocks and toward firms focused on real-world AI applications.
So software and application over pure chips.
Generally, yes. And second, healthcare value. Large-cap, undervalued stocks like Merck. They offer stability, strong cash flow, and analysts are highly recommending them.
But those opportunities exist under the shadow of 3 very distinct scenarios for Q1 2026.
That's right. Scenario 1 is the soft landing. The Goldilocks story continues. That's assigned a 40% probability.
Okay, the most likely, but not by a huge margin.
Not at all. Scenario 2 is an adjustment, a 10–15% correction to rationalize these high valuations. That's given a pretty significant 35% probability.
Almost as likely as the soft landing, and the third.
And finally, the worst case, a hard landing. This would be driven mainly by those tariff effects we talked about, leading to a 20% plus drop. And that is assigned a substantial 25% probability.
A 1 in 4 chance. Those probabilities mandate vigilance. The market is clearly highly conditional. So what are the key economic indicators we need to watch in the early January data?
You need to keep your eyes glued to 2 reports. First, the critical employment situation report in the first week. That tells you about labor market health and wage pressures.
And second,
the ISM manufacturing and services indices. They're a great indicator of corporate purchasing decisions and overall demand.
and from a technical standpoint, what are the red line numbers on the charts? The triggers that tell us the environment is getting really hostile.
Watch the 10-year Treasury yield. 4.5% is the key pressure point. Historically, when the 10-year yield crosses that line, the cost of corporate borrowing really starts to hurt future spending, which puts massive pressure on stocks, especially growth stocks.
And what about the fear gauge, the VIX?
For market fear, watch the VIX. A consistent reading of 20 or higher signals vigilance. It confirms that risk-off sentiment is spiking, that System 1 emotional trading is dominating, which is precisely when disciplined investors should be preparing to buy from the panicked. I think the core lesson of this entire deep dive is this. The market is currently rewarding the past. Those record highs reflect the great performance of 2025, but it is simultaneously warning about the future.
To the downgrades, the GDP skepticism, all of it.
All of it. The most effective investor in this climate isn't the optimist, and it isn't the pessimist. It's the diagnostician who operates with System 2 prepared for opportunity, regardless of which of those three scenarios actually plays out.
To navigate a market defined by such complex contradictions, where you have phenomenal strength and severe warnings coexisting, you just need a continuous, practical process of checking your numbers and reevaluating your risk. Don't let this knowledge just sit there. Use this deep dive to immediately reassess your portfolio's high PER allocation, apply those System 2 rules for cash and defensives, and start building your buy list today. Staying informed and prepared is the only way to maximize returns and protect capital in an environment this dynamic. We'll be here next time to help you sort through the complexity.